So before we dive into to China, Asia in general, just some housekeeping pieces. So there were some fighting between the Taliban and Iran. Remember, and again, it's confusing because for some headlines, some news reports will talk about how Iran is friends with the Taliban, and that's really still not the case. And we saw it again. We had negotiations break down. We had some fighting where the Taliban fired across into Iran, and Iran responded. It was small, it was localized, but it just kind of shows that there is still a lot of heated debate and obviously things that could lead into more of a heated war, or I should say broader border conflict. But these are going to be things to watch in general because they really don't like each other. And that goes back over time. This is not something that I'm just saying flippantly. We've done a deep dive into Afghanistan where we went through why Iran sits and the Shia sit against the Taliban and the Sunnis, or I should say that specific Sunni sect, and why they have such a dislike for each other, as the Taliban were very much against the Tajiks, and they do align much closer with obviously Tajikistan and on a Shia front. So again, there are going to be things to watch in general. The Tajik also align with India, which counters against where Pakistan sits, and the Taliban. So these are some of those interesting pieces. So far, there were news reports. They've so far calmed down, but again, it just shows that there's still a lot of friction in that area, and that's why it'll be one to watch, especially when you look at Iran. Now, moving a bit into where things sit in terms of India and China. So upgrades continue at the strategic Indian Air Force base at Hajimara, begin to show dividends, but this isn't the only air base in India's east that's been improved. Small projects like runway repaving to new infrastructure can be seen far and wide, enhancing air operations. And the reason why you have to enhance air operations, you might think, well, why is that the case? What needs to be added? And when you have to think about, sometimes runways have to be extended. You have to extend them, especially if you have a heavier aircraft that needs more leg room to take off. You have to increase the amount of shells in terms of protecting the assets. What kind of shelters are needed? What extensions are there? But also, can you land in some UAVs? Can you have heliports? These are some of the key pieces because you want to be able to, you can fix and maintain them. And I think the bigger chart, when the bigger map where you look at those boxes where multiple infrastructure upgrades to support UAVs, new and more aircraft, along with providing upkeep and repairs, have been ongoing across various air bases in the eastern sector. And this is right along Bhutan. And this, again, is to counter a lot of these things that we've seen and a lot of the friction along this specific border. We've talked about what's happened in Ladakh and whatnot, but this is now looking more at Bhutan, Doklam Plateau, and you can see that, again, even as China increases, India is not sitting there flat-footed. They are also looking to protect themselves and to strengthen some of their defenses against a potential Chinese invasion, or at least additional Chinese aggression, and trying to, again, solidify and protect themselves in general. So now looking to China, as we turn over here, when you look at non-manufacturing PMI, now we're going to talk about Caxton as well as non-manufacturing PMI, or the official numbers. So non-manufacturing was expected at 51.5, came in at 52.3. Just a little bit below the last month. Manufacturing PMI was expected at 49.7, just eked out some growth, coming in at 50.1, with composite coming in at 52.2. So that's not overly surprising, given that we did get a little bit of a bump in on the consumer side. That helped that non-manufacturing piece. Again, we've talked about how we think that's going to slow down again. So now you get the bump to 52.3, and now we expect this to move much closer to about 51, where the initial estimate was. And then manufacturing PMI, we do expect that to hang around between 49.5 and 50.5, and just kind of get stuck in there, just given some of these pushbacks and these issues that remain between the two sectors. So then when we look at the Caxton Chinese PMI manufacturing, which we have a chart on in a minute, it was expected at 50.6 and came in at 49.9, and that's where we were expecting things to be at, just below growth, just slightly, just given some of the issues that we continue to see and a lot of the leading indicators that are specific to the manufacturing index, which is new orders, imports. That's where we continue to see a lot of these slowdowns, which is why we think the manufacturing side is going to continue to show actually retraction and not growth. And just putting it on a charting basis, you can see where a lot of those pressure points continue to come through as you see China manufacturing PMI and a lot of these, again, still below where things normally are, but starting to stabilize just below growth or just above, just below expansion or just above expansion. But then when you look at the China manufacturing PMI, again, you see we're back down into contractionary territory, but new orders, that leading indicator, is now back in negative territory again. And that's where we see that pressure point. That's where we see some of these issues continuing to feed through the system. And then let's take that to the next level. So what do we know that China did? China issued a significant amount of price protections based on issuing from strategic reserves, trying to push additional production, increasing imports, even if it may not have been geopolitically friendly, trying to offset some of this tightness. And that has resulted in a decrease in import prices, a decrease in output prices, which will be a benefit because you have to think about, well, why would they do this? And it's because they can't pass on inflation to the consumer because they're already struggling. And based on just the different dynamics of the GDP growth, they need some sort of growth, and they're going to rely more on exports. And these two pieces help keep their export prices competitive and moving into the system, which is why they want to try to maintain some semblance or some form of growth as they head into the new year. So, but the local areas continue to fall to continue to struggle, and by local areas I mean local provincial governments and village governments, because land sales aren't there, and gross land sale proceeds continue to drop. You see them hitting a nice high in 2020 and then going into a negative territory in 2021, and land purchases reported by developers. This is the underlying problem, because a lot of the capital that has been used and deployed under the LGFVs or the local government financial vehicles or the special purpose bonds have been financed with, again, these asset sales. So they take this money and then they put it into these investments, and now those investments are underwater. But what is the government doing? The government is trying to stimulate, and by that I mean the federal government, the CCP, is trying to stimulate the economy again and a bit more, and they're issuing broad tax cuts. But that reduces tax revenue for local governments that need it most. So this is where you keep getting this struggle point, and that's why the PBOC is trying to keep the lines of communication open, liquidity moving through the system into these regions, as they've started to take liquidity back out of the market after injecting some into the market into year month end, and now they let 90 billion yuan expire yesterday. We expect more to come, and that's again, even though they're trying to keep some of these governments solvent by keeping money funneling down, they're still trying to protect credit impulses. They're still trying to keep that reined in and liquidity fairly tight. And we don't see that changing at this point in time. Now, when we look at infrastructure and property investment growth, here you can see, as always, infrastructure ex utility property continuing to be negative as we go through 2021, and that continues into December. And then land space acquired has continued to be in the negative on the negative side, which again we don't see adjusting anytime soon. Now, when we look at China's Sales Managers Index, looking at it from the World Economics, you're seeing this pressure come back down. Again, this ties in with what China Beige Book is saying and what we've been seeing. We would say this is actually much closer to 50 than what they're saying. But again, we're all seeing a similar trend. We're seeing this balance out a bit and flatline a touch because we're already down. So we think that they're going to come down a bit and then flatline as we continue to see some of these slowdowns. And the reason why we have that confidence is because sales growth is negative. Prices charged has gone up. Profit margins have come back down. So prices charged, and yes, input and output prices have come down, but they're still trying to recoup some of those losses. Now, prices charged will roll over, but sales growth is not something coming anytime soon as market growth has gone negative and we continue to see profit margins also move negative. So now using some of the China Beige Book data, factory order growth was soft versus the pre-COVID. Despite export orders picking up, domestic orders slid and overall production growth did as well as power shortage continued to be an issue. Manufacturing orders remained lackluster. New export orders were at 48.5 and domestic orders at 49.4. So again, contraction. This is where we continue to see these pressure points, and it's on the domestic side is just as weak, if not getting weaker, as they try to protect some of those export orders by reducing prices. And these are going to be some of these friction points that we continue to talk about and see, which is going to be a big problem in terms of how are they going to stimulate the economy, because they still want to try to stimulate in some way. So we do expect that, again, we've seen that the tax cuts, they'll continue with some of the benefits into year end on VAT tax forgiveness and other types of maybe ways to mitigate against tariffs, some paybacks or some semblance of tax reductions if you can show that you paid these tariffs. So again, there's going to be different movements, and we do expect some sort of shift. And if you listen to the CCP and what the leaders are saying, they're trying to drive home the protection of the SMID caps, the small and medium, and especially the privately owned businesses, and that's going to continue. It's just they haven't found an effective way to do it, and this is just showing another pressure point into year end. And inflationary pressures reduce likelihood of significant easing in China, as we've been saying, as we continue to talk about. Now, some of that has eased with commodities rolling over a bit, as we've talked about, but they're managing liquidity. Even with the managed liquidity, PPI continues to go up. We'll get PPI December 8th. We'll talk about it. Expectations is for it to come down a bit. But again, these are these pressure points where PPI will come down, but we do expect CPI to go up. And that's going to be some of these pressures that we continue to see in general, which is why they're not in any position to ease, as credit impulses remain at near record levels, near record low levels. So 2022 will be a challenging environment for industrial metals. The China credit impulse is down this year and leads by 11 months and could be nearing a major inflection point. And as we continue to see what is happening with manufacturing, what is happening with industrial production, this is why we remain so concerned as we go into 2022 for global growth. Where is demand going to be, not only for crude, but also some of these key industrial metals. And then industrial profits, as we alluded to earlier, you're seeing profit margins come under pressure because they're trying to protect the local consumer, limit the amount of money costs that are being passed through. And here's where, again, you're seeing those industrial profits come under pressure. Now, when you look at global exports in U.S. terms, Chinese credit impulses, you're seeing all of this, again, pulling back down. They're trying to stem the tide. They're trying to protect some of this from going too far down by reducing input prices, output prices, trying to be competitive, which will be a little bit easier as commodity prices come down. Some of those input prices will be a bit protected. But again, you're seeing some of these conflicting issues and why we remain so concerned on global growth in the overall market. Chinese coal output roofed. This was we took out the previous high or record from December 2020, and Chinese coal output in tons hit 357 million. Again, trying to address the shortfalls that are there. They have a record amount of fuel oil in storage. They have now seen their diesel and gasoline storage also increase, which I think will again put additional cargoes on the water as they try to manage. But they wanted to make make sure that they had more than enough for the winter season. Now, when you start looking at home prices, because remember, WMPs, the wealth management products that so many people own, so many consumers own, is going to come under pressure as you keep seeing price declines. Look at the amount of price declines. Almost 90% of areas, almost 70% of areas saw prices decline over this past in October. That doesn't change in November, and that continues to put pressure on the consumer, which is what the CCP is trying to address. And then the monthly residential sales continue to dip down, which is why we're starting to see a little bit of a curve where the Chinese government is now allowing some of these real estate companies to issue local debt. And it doesn't mean that it'll go across at a good price, but it just means that they're allowing them now back into the market to try to get funding, because they're limited in the amount of protection they can give them. And they need to allow a certain amount of recapitalization to close and to finish some of these projects, because the wealth management issue is a big problem for the consumer. And what the CCP is trying to accomplish with, again, that dual circulation strategy and making sure that, again, trying to drive some of this growth in consumption. And we just haven't seen it. We just haven't seen the consumer rebound the way the CCP would want. And then Chinese corporate maturing bonds. This is where you're looking at where home builders are. The LGFVs is a big one in December. Again, those are the local government financial vehicles that will get backstopped by the PBOC. Home builders is going to be a huge problem in January, March, and April, and will be the ones to watch. CAISA has gone out. They're trying to renegotiate with offshore bondholders to bridge some of that gap. And so far, they're still in negotiations, but the negotiations expire today, and they are going to try to definitely find a way to make that work. Corporate maturing or portable offshore bonds. Here you can see December, another big year, and then another big month as we get into both March and April. So now when we look at the high yield index, December's maturity bill is 1.3 billion, but January is the bigger one. Fantasia suspended their Hong Kong shares this morning. And then you look at junk yields are back above 20%. And this is where you're seeing these pressure points. We saw Alibaba fall to a record low. We saw the Evergrande EV or electric vehicle company fell to by about 20% in the overnight market. You're seeing a lot of pressure still remain in the system. It bounced a little bit, but again, I think that there's going to be this big, an accelerating problem as we head into year end, and it doesn't get better in Q1. But they're going to try to do something in January to try to offset, because they do have the Olympics in February. They will want to show some of that strength. So now when we start looking at the China state-owned property firms' onshore bond sales, this is where we saw them hit a record in November, because they're Chinese state-owned property firms. So that the state already owns them, and they're allowing them to recapitalize. And I think that's going to be the big disconnect that we really want to understand. Where are the private companies? Where are the state-owned companies? And who will they allow to go bankrupt? Who will they allow to restructure or recapitalize? So Chinese state-owned property firms have sold a monthly record of 64 billion yuan or $10 billion of local bonds so far in November, at a time the nation's private developers have been scrambling to alleviate their financing stress. So again, state-owned versus private. Yields on Chinese junk-rated dollar bonds, a market dominated by private sectors, spiked to 25% earlier this month, all but shutting out some of the offshore market and crimping issuance of such debt by real estate companies. SOEs selling more local debt will ensure projects are completed and should help stabilize the housing market sentiment in the near term. But it doesn't do anything for the private side, and that's where I think you're going to see a bit more concern, because state-owned will obviously they're state-owned, they're going to try to protect. But the reason why is, again, coming full circle to what we talked about in the very beginning of the segment, there's a lot of exposure for local governments, local tax revenue, local revenue in general that is being missed. And they are trying to find ways to allow them to recapitalize so they can continue to pay local governments. They can continue to try to finance the debt, or that the infrastructure bill, the infrastructure loans that were issued, or the LGFVs, the local government financing vehicles. It's all a connection. They need to find a way to protect government tax revenue. Even though they're providing tax cuts in other areas, this is a way to keep some of these governments solvent, even though they're far from it. Kaisa Group, as we were saying earlier, is asking creditors to swap at least $380 million of its bonds. The builder has offered to exchange at least 95% of its $400 million, 6.5% maturing note maturing December 7th for new notes that will, with the same coupon maturing June 23. If the offer to bondholders fails, the developer may not be able to pay bonds and could consider a debt restructuring. Kaisa bonds fell while shares jumped as the stock's trying to resume trading. Again, this is where we have to see how this shakes out. But there's also a labor issue, and this is increasing underlying costs, and I think is something that they're trying to address. So for those that aren't aware, China is making it easier for non-residents to get residency, especially for young professionals, because they're trying to close this gap, especially not only just on the urban jobs or some of the more menial jobs, but also for the jobs that are in high demand, the intellectuals, the PhDs, people to try to create and drive some innovation. That's where we're going to see some of these biggest issues. But you can see the shortfall. And when there's a shortfall, there's one of two things: increase prices, increase wages to attract more people. And that's something that I think is going to, again, is that inflationary pressure that sits behind it, because as wages go up, so does underlying prices. And again, these are going to be things to watch, but they're trying to address it. They're trying to make it easier for immigrants. They're trying to make it easier for expats and others to come into the country and get residency. Now, when we look at Japan, some broad updates in general. So the PMI manufacturing came in better than last month at 54.2. Same with services at 52.1, rounding out at 52.5. Kind of right in line with where we had our expectations on a nice little bounce in Japan. PMI services was expected at 0.9, came in at 1.1%. Again, slight increase, slight movement in some of the things that we're seeing on the pricing side. Leading index came in at 100.9, a bit better than the previous month. Starting to see some of that movement in the right direction. Same with department store sales. CPI starting to creep up just a bit, but again, still fairly low for where things are at this point in time. October retail sales month over month, right in line with expectations, but it's still showing some of that positive growth. So again, Japan continues to be a bit of a bright spot, but there's some good things, some bad things, but on the aggregate, they're all in a steady expansionary mode. India, you had the GDP coming in expected at 8.3%, came in at 8.4%. And then the market, India PMI manufacturing came in at 57.6, which was well above the prior month at 55.9. We were expecting to see a nice little pop in manufacturing just because we did see a lot of strength on the import side, and we expected to see manufacturing pick up a bit. We think now it starts to roll over. And again, by roll over, I just mean coming back closer to about 56 as we see some of the inflationary pressures and some of these things offsetting as we head into December. Now, when you look at the India manufacturing, what I'm saying, again, is not a huge step out. As you can see, starting to run up and then rolling over a bit, but still remaining at a very strong level, especially when you compare it over the last couple of years. It's just, what is the consumer going to do? How is that going to play out as some of the prices continue to move higher? And then this is looking at imports slumping. So India's inbound shipments of fertilizers dropped on global shortages. This is the problem when you look at underlying costs. So we talked about some inflationary problems within India, and this is the key one: is as prices go up, food is a huge piece of it. Obviously, a lot of India is fairly poor, and a large part of their paycheck, month in, month out, goes towards food. So these types of fertilizer drops on the global shortage is driving up prices. They're actually turning to the black market to get fertilizer, which, as we all know about black markets, there's massive price gouging. There's massive increases in prices because you're doing things to get around tariffs, to get around different types of hindrances and hurdles. So again, that's going to increase the cost. So the cost of food is going higher, which is why we see inflation accelerating, which is going to cap manufacturing increases, which is going to cap the consumer and put some pressure on the underlying Indian economy. Vietnam, on the other side, exports had a nice bounce, expected at 7%, came in at 18.5%. Imports were expected at 8%, came in at 20.8%. Now, remember, as I keep saying, imports are a good leading indicator for exports. We continue to see Vietnam be a fairly strong bright spot, but we do see inflation accelerating. As you can see here, CPI expected at 2%, came in at 2.1%. Retail sales came in negative at 8.7% year on year. Industrial production, nice bounce. PMI manufacturing came in at 52.2, same as last month. Exports will remain strong. That'll keep manufacturing fairly well comforted. Local consumption still remains a big headwind. We think that that's going to be an underlying problem, but and by underlying problem, I mean for the total growth of the Vietnamese economy. But the exports will remain a bright spot and will support some growth over the next few months. And this is just showing how exports have accelerated out of Vietnam, reaching a new record. Again, this isn't adjusted for inflation, and it's just looking at the dollar amount. But still, it means they're able to pass things on, and this is going to be a positive for the economy, even as the local consumer within Vietnam continues to be face headwinds just based on price increases and just underlying pressure in general. Now, when we look at South Korea had a huge increase in PPI. It was expected last month was at 7.5%, came in at 8.9%. Again, seeing that inflation continue to shift higher. Department store sales dipped down a bit, but still remains fairly strong. Business survey, manufacturing, non-manufacturing, still fairly stable, with consumer confidence still sitting there at an elevated level. Again, all moving in the right direction. Industrial production was expected at 2%, came in at 4.5%. And then when you start looking at exports were expected at 27.2%, came in at 32.1%. Imports were expected at 39.6%, came in at 43.6%. Again, these guys are still blowing it out of the water. They're still crushing it on the export side. And that's to the degradation of China. So China, and again, not to say that they're going to see a huge dip, but this is why China is trying to compete. Vietnam exports are up. Taiwan's exports are up. Singapore, South Korea, all of these exports are up and elevated. And this is what they're trying to protect in terms of market share, because China needs some form of growth. GDP came in right in line with expectations. Market, South Korea PMI manufacturing last month was 50.2, came in at 50.9. We expect it to remain at a nice extended, maybe even a little bit of a spike to about 51.5. Now, when we look at GDP coming in right in line with expectations, CPI was expected month over month at negative 0.2, came in at 0.4. Again, inflation shifting to the upside, which is why the central bank is trying to get in front of it, which is here when we start looking at PPI in general. PPI is now back to where it was in 2010, and we think it's going to continue to drive higher to where it was in 2008. And you can see the lag between CPI, which is why the central bank's trying to get in front of it to try to cap. But again, we still expect to see more of this pass through to the system. Then when we look at outstanding household and corporate debt, you can see that in terms of where all of these different countries are, Indonesia, India continues to be elevated. But if you look at China and Korea, this is why we talk so much about these two countries. Korea has about 220% of GDP in debt between both corporations and households. China sits at about 225%. This is why inflation is so bad. This is why rates, impact them so much, especially for Korea on the household side, which is why they're trying to get in front of inflation. But by raising rates, you're going to raise cost, and that's going to, again, cause some headwinds for GDP growth. South Korea industrial production dipped, but again, this is something that we expect to rebound back within this normal trend line, especially with exports being as strong as they are and imports coming in as strong as they are. Now, you can see here the South Korean manufacturing, strong growth, normalized, and now we think it stabilizes here as we go through the remainder of the year at about 51.5. Then when you look at the core CPI forecast, you can see it continues to trend up, which is why the Bank of Korea has raised rates and continues to try to stay ahead of the inflation game, even to the detriment as they raise rates. It'll make it more expensive, but they're trying to rein in some of this debt, rein in some of this liquidity to try to stay ahead of these increases in inflation. So I know we covered a lot. If you have any questions, please let us know. You know where to find us. You can find me at MarkFNY or in the comments section. We'd love to hear from you. And tomorrow we'll have our normal fun frac spread show. I know you guys missed me last Friday, but we're back at it, and we'll give you some color on what we expect into December and next year. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.